All right, good evening, everyone, and welcome to week number 5 for public budgeting and finance. This is week 5 out of 6. So we have our Zoom session tonight, and then we have one more Zoom session next Tuesday. And then our class officially ends then on June the 30th. So we are almost done. Goes by very quickly, but I think we're in really good shape to cover all the information that we need to cover for the course and still bring everything in and get everything done on time. Let me just do a couple of housekeeping items and then a couple of quick ones, then one very long one, which will take us a little bit of time. But the first housekeeping item is to say thank you for Canvas essay number 3. As you know, I was only looking for you to calculate a couple of these ratios that we had talked about for fiscal solvency. As we had talked about before, if we were actually going to measure the fiscal solvency of a city, we would calculate the ratios for not just our city, but for comparable cities as well. We would then array the cities from top to bottom in terms of their ratios on each one of those different indicators. We would then see where our city sits in terms of being in the top quartile or the second quartile, the third quartile, or the fourth quartile. And oftentimes what we would then do is we would then assign numeric scores to each one of those quartiles. So if our city was in the bottom 25% on that indicator, it would get a -1. If it was in the second quartile, it would get a score of 0. If it was in the second one from the top, it would get a score of 1. If it was in the top 25%, it would get a score of 2. We would do that for all of our indicators. We would then add up the scores, and then that would give us an idea of how our city fares relative to comparable cities in terms of their fiscal solvency. But I did not ask you to do all that work. All I ask you to do is just calculate a couple of ratios. And I think almost everyone did a really nice job doing that. So thank you for putting that effort into Canvas essay number 3. Canvas essay number 4, you then have due coming up next week on the 26th. And for Canvas essay number 4, it's a pretty straightforward one where you are just comparing the advantages and disadvantages of different types of long-term debt. So those bonds that we talked about last week, those will then be the focus for Canvas essay number 4. And then also on the 26th, you have your post-instructional assignment that is also due. So in that post-instructional assignment, just as a reminder, in part 1 of the post-instructional, you are just simply doing a redo, if you will, of the pre-instructional assignment. So just answering those 8 questions, but now using all the information that you've acquired in the course in order to answer those 8 questions. And so for part 1 of the post-instructional, you will need to provide answers for each one of those 8 questions. Saying I don't have the information, obviously, is not a valid answer anymore on the post-instructional assignment. I think we had already discussed that to make it easier on you, if you just want to take your pre-instructional assignment and then just insert your post-instructional answers for each one of those 8 questions, just using a different font color if you want to use red or blue or whatever you'd like to use, just to differentiate your post-instructional answers from your pre-instructional answers. I think that provides a really nice comparison point, not just for you, but also for me as I go through and review those post-instructionals. So that's part 1. As you know, in part 2, you're using that exercise I provided to you to put together a consolidated library budget. You'll be turning in a spreadsheet with your consolidated budget that adheres to those 6 different parameters that we had talked about before in the Huddleston file. And then also provide me some justifications for why you made the cuts that you made in order to get your overall budget down to the target figure, which is 3% less than the original aggregate budget. So your first step, obviously, is to add up all the spending that's being done by all the branch libraries. Then from that figure, you then subtract 3%. That then gives you the target figure for your new consolidated budget. So part 2 will then be that consolidated budget and then the justifications for why you made the cuts that you made. You can either include your justifications as comments on your Excel spreadsheet, or if you'd like to turn in a separate Word document with your justifications, that is fine as well. But that part two, the primary focus will be on that Excel spreadsheet that you're creating for your consolidated budget. So that post-instructional assignment parts 1 and 2 are then also due on June 26th. So you've got the Canvas essay number 4 as well as your post-instructional assignment due on the 26th. Any questions about either the Canvas essay 4 or the post-instructional? Lizette, go ahead.
Yes, thank you. So my question is, for the pre-instructional assignment, I looked up at the city of Irvine. I looked at the proposed budget for 23 to, I believe, 25, because they go according to 2 years. My question is because the last 2 questions of the post-instructional assignment is asking about solvency, fiscal solvency. Would the responses that we provided in our discussion, our Canvas essay, are those appropriate answers? Because I used the 2022 report instead of, obviously there's no report for the upcoming fiscal year. Is that still okay to say that or provide that?
Yeah, that's absolutely fine. And one of the goals of that Canvas section number 3 was to allow you to, try out some of those ratios that you can then use for that answer on the post-instructional. So absolutely, you can use what you used on Canvas Essay 3 to answer that question on the post-instructional. Absolutely.
Wonderful. Thank you so much.
My pleasure. Any other questions on the post-instructional?
Hi, Professor. Yes, I had a quick question.
Go ahead.
So for the post-instructional, I was just a bit confused. I know for one of the parts it says we have like $45,000 for that one position. But what other money did you want us to look at? Did you want us to look at the city budget for our libraries that we've been looking at, or is there a specific?
No, you don't have to look at anything other than just the information provided in that assignment. So you'll just use the information in that spreadsheet, that line item spreadsheet, for all those county libraries, all those branches for that assignment. So this doesn't really, in terms of putting your spreadsheet together in part 2, it doesn't relate to your city's budget. You're just using the assignment that's provided to put that spreadsheet together.
Oh, that makes sense. Thank you so much. I appreciate it.
Sure, yeah, no problem. As always, as you're working on this and putting the finishing touches on it this week, I'm available via email. So feel free, if you have any other questions, feel free to shoot me an email and I'll get right back to you and clarify any questions that you may have on the post-instructional. Then what we are looking at is for next week, our final week, you then have Canvas essay number 5, and then you have this final assessment. And those assignments are then going to be due on our very last day of summer term, which is June 30th. So you've got some time next week to work on those 2 assignments. For Canvas essay number 5, that one focuses on the information from tonight's class, which is our discussion of taxation. So all the information you need for that, you will get tonight in our discussion on taxation. The final assessment I have made available on our Canvas site, but I thought it would be instructive for us to spend a few minutes here going over the final assessment so I can kind of show you what it looks like and give you an idea in terms of the types of responses that I'm looking for in terms of content as well as length of the responses. So I'm going to share out with you now, and you should be able to see it if screen sharing is working. Is the final assessment, exam assessment, you use whatever term you would like for this course. The final assessment is organized around 5 different scenarios, and then each scenario has 2 questions attached to each scenario. So it's a grand total of 10 questions, 2 questions related to each of the 5 scenarios. So what I am looking for here is I'm looking for parsimony. I'm a big believer in being concise, be as concise as you possibly can be, and still answer the questions that are on the final assessment. So you don't have to look to write any type of a thesis or dissertation here. Typically, for each one of the questions, a paragraph or 2 will probably be sufficient to get the job done, as long as you're including the necessary information in those 1 or 2 paragraphs. So try and be as parsimonious as possible. So let's run through the 5 scenarios and the related questions and make sure again that everyone's on the same page and knows what the expectations are. So here we have scenario number 1. And scenario number 1, you have the city of Lake Powell. I get to name it after myself. So the city of Lake Powell is located in the northeast region of the county of Confusion. Lake Powell has a population of approximately 75,000 residents in a healthy, real, and commercial property tax base. The city is fiscally solvent and recently contracted with the county sheriff for law enforcement and fire services. And we see this in a lot of cities here in California. We refer to them obviously as contract cities, where they don't maintain their own police department or fire department. They contract with the county to then provide those types of services. It has been so pleased with the quality of services it received through contracting that the City Council is now considering contracting out its library services as well. The city currently has 2 library branches with a combined budget of $5.2 million. These branches are staffed with city employees. The City Council received a recommendation from the city manager to consider entering into a contract with Library Alternatives Incorporated, which is a private company, to staff and operate these branches. Library Alternatives Incorporated currently has contracts with 2 other cities in the state that allow the company to operate all aspects of library operations in these cities. The contract the City Council will consider would replace the current city library employees with Library Alternatives Incorporated employees, and the company would commit to interviewing city employees first if they are interested in applying. The annual amount of the contract would be $4.5 million, resulting in $700,000 in savings for the city. You know, it's oftentimes the reason why we contract out is to do it more efficiently and hopefully at a lower cost. One reason why the contract amount is lower than the current library expenditures is due to Library Alternatives' practice of charging a membership fee for users. There is a waiver fee, a fee waiver, or there will be a fee waiver for users who can demonstrate that the fee would create a financial burden. So the first question is, what kind of good would you consider library services and why? And we had talked about different types of goods very early on in our time together. We talked about public goods versus private goods versus toll goods versus common pool goods. Public goods being non-excludable and non-exhaustible, private goods being exhaustible and excludable, toll goods being excludable but non-exhaustible, and then common pool goods being just the opposite of toll goods. So what type of good do you think library services represent? And then give me a justification as to if it's a public, a private, a toll, or a common pool good. And then the follow-up question, if you were advising City Council, what issues would you recommend the City Council members consider in deciding whether or not to award the contract? So what are some of the considerations the City Council should keep in mind in deciding whether or not to privatize library services? So this kind of gets us at some of our preliminary information that we covered very early on, I guess 5 weeks ago in the course. So then we move on to scenario number 2. And for the sake of consistency, we're going to keep some constant threads going between the scenarios. So here we're dealing with the city of Lake Powell again. While the city of Lake Powell is thriving financially, the county of Confusion has not been so fortunate. Confusion is facing a myriad of fiscal troubles. To start, the county has failed to get its budget done on time for 6 of the last 7 years. One reason for this is the partisan divides within the county commission. While the commissioners are supposed to be nonpartisan, as local positions typically tend to be here in California, it is clear that 2 of the commissioners are Democrats, 2 are Republicans, and 1 is a declare to state, who normally caucuses with Democrats on some issues and Republicans on others. So you have your classic 2-party split with 1 party in the middle that kind of bounces back and forth between the 2 parties. The second major problem the county faces is declining revenues and increasing expenditures. More affluent residents have been moving out of the county in recent years, thus eroding the real property tax base and making it more difficult for the county to balance its budget. This is a common problem in a lot of metropolitan areas. We've seen this as people flee city centers and metropolitan areas to move to In primary and secondary and tertiary suburban belts, you have an erosion of the property tax base for these counties and for these cities. So you've got people moving out of your city, which erodes your tax base. Citizen watchdog groups have also filed a series of expensive lawsuits against the county agencies claiming fraud and abuse in the way in which the county programs are being implemented. Frustrated by the confluence of these events, the commissioners finally agreed on one thing. It was time for a change in budgeting. They charged the county administrator's office, the CAO, with exploring different types of budget formats and presenting a recommendation to the county for how to change its current line item budget. You are a management analyst within the CAO and have been tasked with recommending a new budget format. Given the limited information you have in this scenario, question 1, recommend a new budget format to replace the current line item approach and explain why this approach is most appropriate. So we presented 4 different budget formats in this class: line item, performance-based, program-based, and zero-based. So what new budget format would you recommend to replace the current line item budget? And then the follow-up question, select one of the formats that you did not recommend and discuss why your preferred choice is superior to this format. So if you say they should use a performance-based budget, then in question 2B, then you will select one of the ones you didn't choose, so program-based or zero-based, and tell me why performance-based budgeting is superior to one of those other options. That's our budget format scenario. Then moving on to scenario number 3, you finally complete your recommendation to the commissioners for a new budget format and are about to settle back into your daily routine. As you check your email, you realize there's a message marked urgent from Commissioner Rudy Diaz. It is somewhat unusual to receive emails directly from commissioners, so you immediately open it and find that Commissioner Diaz has a new task for you. Commissioner Diaz used to be the chief of staff for Congressman Mayhew prior to running for the commission. You used to bump into him on Capitol Hill back in the day when you were interning for the House Ways and Means Committee, so Commissioner Diaz knows you are familiar with the federal budget process. He is anxious to change the county's budget process and thinks the county can learn a thing or two from the federal government. Why, I don't know, but he does. In his email, he asks you to prepare a memo to the commission describing the federal budget process and suggesting how adopting certain elements of the federal process could help the county. The CAO is aware of the commissioner's request and has cleared you to work on the memo. So there's no pushback from the CAO's office. Your boss has told you go ahead and work on this memo for Commissioner Diaz. So first question here, describe the steps in the federal budget process that you would include in your memo to Commissioner Diaz. So it's just a general overview of how the federal budget process works. And then the follow-up question, identify 2 aspects of the federal budget process that could be helpful for the county's process and 2 aspects that would be hurtful and should be avoided. So 2 good aspects and 2 negative aspects of the federal budget process. So clearly that's our federal budget process question. Then scenario number 4, the fiscal problems of the county have extended to its ability to maintain county parks. The city of Lake Powell takes great pride in its city parks, but there is one county park within city limits that has fallen into disrepair. Buzz Luking County Park is located within the city of Lake Powell and is managed and operated by the county. It has been poorly maintained over the years, and the recreation center at the far end of the park is crumbling and not safe for use by residents. City officials have been complaining to the county commission for years that the park is an eyesore and should be renovated. The commissioners finally relent and agree to landscape and refurbish all aspects of the park with the exception of the recreation center. The recreation center is in such disrepair that it will need a major renovation. The county simply does not have the resources or the debt capacity to fund the construction project, so the city volunteers to step in and pay for construction. It would require that the county allow the city to annex the land that the recreation center occupies, and the city would then own the recreation center. Demolition and construction costs are estimated to be $12.5 million. The county charges a fee for users of $10 per month, and the center had 5,000 users per month at its heyday. The city assumes that we'll be able to increase the number of users to 7,000 per month for the newly reconstructed center. The commissioners agree to Lake Powell's proposal and the project gets the green light. Even though the city is fiscally solvent, it does not have the reserves necessary to fund the project. Therefore, it decides to issue a bond to fund the project. Question A, based on the information in the scenario, what type of bond would you recommend and why? And so again, this gets to our information from last week. And then question B, compare the bond that you are recommending to another alternative and describe why your chosen bond is superior. So that's our long-term debt scenario. And then our fifth and final scenario, number 5, between the privatization of the library system and the construction that is happening at the recreation center, things have been busy in Lake Powell. That is when the news hits the local media. The city's largest employer, Wally's Widgets, announced that it is moving operations to Morrisville by the end of the month. This will mean a 10% loss in corporate property taxes, about $5 million, and an estimated overall loss of tax revenue in the amount of $7 million. Now the city needs to find a way to replace that revenue. It can replace this lost property tax in a number of ways. The county offers senior homeowners a $7,000 per year homestead exemption, and we'll talk about exemptions tonight, that reduces property tax liability. The city offers an additional $2,000 exemption on top of the county exemption and could eliminate this additional $2,000 exemption, which would then generate additional property tax revenue. There are 1,500 parcels that currently receive this additional exemption, and its elimination would generate $3 million. So if you want to do that, that'll give you those $3 million. Another option available to the city is to take advantage of the 20-cent local options sales tax that the county allows cities to use. Lake Powell has not needed to use this in the past, but taking advantage of this would generate an additional $4 million. The city does not have access to an income tax, but can increase the fees it charges to developers. There are 2 new developments in the city, and the city would generate an additional $3.5 million by increasing these fees. However, developers will certainly pass these fees along to the new homeowners through increased home prices, which may discourage people from buying these homes. Question 5A, compare the major forms of taxation, property sales, and income, and we'll talk about all those tonight, in terms of the evaluative criteria for taxation. And we'll talk about the 5 evaluative criteria for taxation when we're done talking about the final. And then question 5B, which form or forms, plural, of taxation or other source of revenue would you recommend to the city and why? So the information on the advantages and disadvantages of different types of taxes and how those taxes relate to the criteria we use to evaluate taxes, all that information will be covered tonight. So by the conclusion of class tonight, you'll have all the information that you need to then answer those questions on the final assessment. Again, be concise, be parsimonious, 1 to 2 paragraphs for each of the questions, I think will certainly be sufficient to then get that job done. So that is our final assessment. I know most people probably haven't had a chance to take a look at it yet, but I just wanted to go through it with you. So we're all familiar with what's being asked and some of my expectations in terms of length of answers. So just, you kind of have some familiarity with the final assessment. As you work on it, again, feel free to send me an email if you have any questions or need any clarifications. This final assessment, as well as your last Canvas essay, are then due by midnight on June 30th. So it gives you about a week and a half to work on both Canvas essay number 5, as well as this final assessment. I like using assessments like this that are scenario-based because I really think, again, an MPA program is really about the application of skills and theories. It's not just about learning about theories, it's about how can you apply those theories appropriately in appropriate situations. And I think, that's kind of the whole heart of an MPA program. And so that's why I like to use assessments like this. I also like to write the scenario so that they all kind of connect together. So there is some connective tissue between all the scenarios. And so that's why they all deal with the same city and the same type of county. Ready? Any quick preliminary questions on the final assessment? Again, any questions that emerge or clarifications needed, feel free to send me an email. I'm happy to answer any questions except what's the answer to questions 1, 2, 3, 4, and 5. Other than that, I'm happy to answer any questions you may have. Okay, let's get into our substantive information for the evening. Let me share out the slides for tonight. Start up the show. It'll start and open my chat. Right, there we go. Make sure we are recording, and we are. So what we're going to talk about tonight, obviously, whoops, I don't know why it started there. Back. The topic of taxation. And I know it's everyone's favorite topic. Everyone loves to pay taxes, but it's something that we have to do, and it's a way in which a lot of governments generate their revenue. So it's important for us to talk about different types of taxes, their advantages and their disadvantages, when they are practical, when they may be a little bit less practical to use those types of taxes. So tonight we're going to talk about tax revenue. We'll also probably, hopefully, fingers crossed, have time to also then briefly talk about non-tax revenue sources, such as user fees and user charges. And then for our class next Tuesday, we will focus on intergovernmental sources of revenue. We'll talk about different types of grants. We'll talk about the fiscal implications of different types of mandates. And I'm hoping next week that we won't have to have a full session, because once we cover the intergovernmental fiscal relations section, that will probably take us about an hour or so, somewhere around there. I can then give the rest of the session back to you so that you can spend that time working on either your final assessment or your final Canvas essay. So that is the plan, and let's see if we can stick to it tonight. So where I usually like to begin our discussion of taxes is to start with these tax evaluative criteria. And this is something that Mike Sell spends some time talking about in his textbook. We kind of approach the issues similarly, but with a few little differences here and there. So we're talking about evaluative criteria. We're talking about the criteria that we use to evaluate the appropriateness of a form of taxation. And this will kind of get us to those advantages and disadvantages of each of our major forms of taxes. The three main forms of taxation we focus on in this class: property taxes, income taxes, and then consumption-based taxes, most notably the sales tax. So we're comparing between those three different types of taxes. There are 5 criteria that we can use to choose between those tax sources. The first criteria is very simply burden distribution. This is the question of, well, who pays the tax? Who should bear the burden of paying this tax? Whenever we are saying the word should, we're saying who should bear the burden, we are naturally asking what we call a normative question. Now, you can have descriptive questions and normative questions. Descriptive questions ask the question of, well, what is? Normative questions ask the question, well, what should it be like? So with a normative question, we really have very value laden. It gets to be a little bit subjective, because for one person, the group that should be paying the burden of taxation may be different than for another person. So who pays the taxes? Essentially, there are 2 different ways in which we can distribute the burden of taxation. One basis we can use is ability to pay. And that's what we do for taxes such as income taxes and to a degree property taxes as well. So people with more of an ability to pay will pay more of their resources in taxation than people who have less of an ability to pay. We see that with the graduated income tax systems that we use at the federal level, as well as the graduated income tax system that we use here in the state of California. Very common way to distribute that burden. Those who can pay more will pay more in taxation. Then there's the benefits received principle, where we distribute burden based upon who is deriving a benefit from oftentimes consuming some type of a good or service. So, the classic example of a candy bar in a convenience store. You've got the candy bar in the convenience store. If you go in there, you purchase it, you consume it, you are deriving a benefit from consuming that candy bar. And so therefore you pay a sales tax on the value of that benefit of consuming that candy bar. If I do not go in there and buy the candy bar, then I don't get any benefit. So therefore I don't have any tax burden. I don't have any tax liability. So sales, consumption-based taxes tend to be benefits received principle. Income property taxes tend to be an ability to pay principle. Then closely related to burden distribution is this question of equity and fairness. Is tax fair? Does it treat people from different capability levels in a fair type of manner? When we are measuring the equity and the fairness of a type of tax, we usually break it up into two different possibilities: regressive versus progressive taxes. A progressive tax is a type of tax where people with more of an ability will pay a higher share of their resources in taxation. That's why as you move up in income level with the income tax, you will pay at least in theory, a larger and larger percentage of your income in taxation. That's a progressive tax system. A regressive tax system is just the opposite. In a regressive tax system, people with less capability to pay the tax will end up paying more or a larger share than people with more of an ability. This is where we run into some trouble with things such as a consumption-based tax. Sales-based, consumption-based taxes tend to naturally be relatively regressive in nature because we are not asking the income level of the person who's purchasing that candy bar. We're not asking the income level of that person who's purchasing the foodstuffs at the grocery store. So you can have a sales tax that tends to be regressive and hurt people with less disposable income more than people who have more disposable income. And we're going to use the term disposable income a lot tonight. And when we're talking about disposable income, we're talking about the amount of income that a taxpayer has left over after they have already acquired the staples of life. So after they have already purchased food and clothing and shelter, pharmaceutical medications, prescription medications, after they've already purchased the staples of life, how much money do they then have left? That's what's considered to be disposable income. So we have to be concerned about the fairness of the tax, how regressive versus how progressive that form of taxation is. Then a third important criteria is obviously adequacy. And with adequacy, we're talking about the concept of yield. Whenever we're talking about taxation, the amount of money we are generating from that tax source is referred to as the tax yield. All three of our main forms of taxation tend to produce a relatively adequate yield. Some of them tend to produce more yield than others. The federal government relies almost exclusively on the federal income tax because it is a very adequate form of taxation. They can generate a lot of money from that federal income tax. Local governments historically, and this has changed in California after Proposition 13, but historically local governments rely more on the property tax. And one of the reasons why they do that is that it's a very stable yield that you get from the property tax. Typically, property values continue to increase unless you have some major housing crisis like we saw back in 2007 and 2008. Typically, values are going to be going up from year to year. That appreciation then brings in more property tax revenue. It makes it a very stable form of revenue for local governments. So they like the property tax because it has a very stable, adequate yield. Then the next criteria is collectibility. How collectible is the tax? Some taxes are naturally more collectible than other taxes. And what we oftentimes look at is we look at the amount of effort that a government puts into collecting the tax levy that is owed to that government. The more effort they are putting in, chances are the higher the collectibility of that tax. But some taxes are naturally more collectible than others. And that deals with this idea of taxes can be either taxpayer or have elements of being taxpayer active, or they can be taxpayer passive. A tax that is taxpayer active means that the taxation gets calculated and remitted directly by individual citizens. The taxpayer is active in declaring how much tax they owe and then remitting that tax to the government. In a taxpayer passive type of tax, the taxpayer doesn't have that same active role. in calculating and remitting the taxation. So examples of a taxpayer active tax. If you're looking at something like the income tax, when we get to April 15th, the income tax becomes very taxpayer active. We have to fill out our tax forms, we have to declare our tax liability, and then we're expected to then remit that taxation. However, through the withholdings process, when you have taxes withheld from your weekly or biweekly or monthly paycheck, that's a much more taxpayer passive type of process. And so when it's taxpayer passive, it tends to be very collectible. When it's taxpayer active, it becomes a little bit less collectible. So the income tax combines both taxpayer passive as well as taxpayer active. You look at kind of a similar situation with the property tax. If you are a homeowner, you know that you can either have your property taxes impounded, which means they get rolled into your mortgage payment, or you can pay your property taxes directly to the county assessor, typically twice per year. If you pay directly to the county assessor, you have two very large tax bills that come due 2 different points in the year, and that's a very taxpayer active way of paying property taxes. If you have your taxes impounded into escrow and into your mortgage, it gets rolled into your mortgage payment and it becomes less taxpayer active because it's all part of your mortgage payment. So for the property tax, it depends on whether you have it impounded or you don't have your taxes impounded. For something like the sales tax, the consumption-based tax, those taxes tend to be very taxpayer passive because the tax gets rolled into the price of the commodity that you are purchasing. And then the vendor, whenever they sell that commodity to you, they will then remit the tax owed to government directly from the vendor. So it's not coming from the individual taxpayer, it's coming instead from the vendor. Governments will then provide indirect costs to the vendor, and they may push back 1% of the sales tax rate to the vendor to keep the vendors compliant and make sure that they are remitting that tax to the Department of Revenue. But it's much easier to collect taxes from a small number of vendors as opposed to collecting taxes from a large number of taxpayers. So sales tax tend to be very taxpayer passive, which tends to make them very collectible forms of taxation. Then your fifth and final evaluative criteria is economic effect. And here we're really looking at a two-way street. We're asking the question, how does the tax affect economic activity? And then how does economic activity affect the amount of tax revenue we are able to generate? Some forms of taxation are very well insulated from economic fluctuations. Some are very closely tied to economic fluctuations. So you think about something like the sales tax. The sales tax is going to be very closely tied to economic fluctuations. When people are out of work, they have less disposable income. When they have less disposable income, they're not going to be purchasing goods. If they're not purchasing goods, then the government is not collecting sales tax revenue. So it's a very close tie to the economy. Income taxes can also be closely tied to the economy. When you have people out of work, then they're not generating income. If they don't generate income, then there's no income for government to tax. Contrast that to property taxes. Property taxes tend to be much better insulated from economic fluctuations. That there's always the American dream of buying a home, and so people are always going to want to buy homes. And so even if you're in poor fiscal times, if they can get mortgages, people are still going to purchase those homes. And the value of those homes are going to remain relatively stable, regardless of what's going on in the economy, unless you have some major housing crisis. So the different types of taxes are influenced by economic fluctuations differently. These taxes can then also influence the economy. And so you think of something like the sales tax. If we want to increase our sales tax rate, whenever you increase your sales tax rate, that is going to have a price effect. That's going to raise the price of that good. Once you raise the price of that good, if demand for that good is very price elastic, then people are going to stop purchasing that good. When they stop purchasing that good, then you're going to end up losing sales tax revenue. So the influence the sales tax has on economic fluctuations and economic patterns will depend upon how price elastic or how price inelastic that good happens to be. Gasoline, motor fuels tend to be relatively price inelastic types of commodities that people need to put gas in their car, they need to get to and from work. So they're going to purchase that gas, even if you increase the sales tax, what we call the motor fuels excise tax on every gallon of gas. There's a situation several years ago where DC decided that it wanted to generate more money from the motor fuels excise tax. So DC greatly increased its motor fuels excise tax, thinking, well, it's a very price inelastic good, and so people are going to continue to purchase it. It's not going to have a big impact upon demand. What DC forgot is where they are located. And they're located in very close proximity to suburbs in Virginia and in Maryland. So residents of DC would just drive over the border, go to Virginia, go to Maryland, and avoid paying the tax. So you got to keep in mind where you are located, even if you are taxing a very inelastic type of a good. You also think about in terms of how income taxes can influence the economy. If you increase your marginal tax rates too high, then people will decide not to work overtime. They'll say, well, I was going to work overtime, but if I work overtime, it's going to push me into a higher marginal tax bracket, and then I'm not going to realize as much revenue as I normally would working that overtime. It's what we call distorting the work-leisure preference. And so if you increase your income tax rate too much, people will choose leisure over work, and then that will lead to less productivity and a less vibrant economy. And so you got to remember this is a two-way street. How does the economy affect the tax? And then how does the tax in turn affect the economy? So those are 5 evaluative criteria. And as we talk about each of our major forms of taxation, when we conclude our discussion of a form of taxation, we are then going to go back and look at again how that tax fares in terms of these 5 evaluative criteria. And I like using these criteria because it really gives us a nice thread that ties our discussion of these 3 different forms of taxation together. So let's spend a little bit of time talking about our 3 forms of taxation: property taxes, income taxes, and then consumption-based taxes. So let's start with the property tax. Since most of us are employed at the local level of government, we know that local governments traditionally generated a good amount of their revenue from the property tax. That's kind of the traditional form of taxation for local governments. And next week, when we talk about intergovernmental fiscal relations, we will talk about a concept known as source separation. And in taxation, in our federalist system, we try to achieve source separation, whereby different levels of government rely upon different forms of revenue. If you have all 3 levels of government that are relying all on the income tax, then you're going to overburden your residents in terms of their income tax rate. So typically, local governments rely upon the property tax, the national government relies upon the income tax, and then state governments tend to rely upon a mixture of income and sales taxes. And that's what we call source separation. So property tax is still important for local governments, but it is no longer the primary source for local governments here in California. Prior to the passage of Proposition 13 in 1978, we'll spend time talking about the mechanics of Proposition 13, but prior to the passage of Proposition 13, the average local government in California got about 41% of its revenue from the property tax. And the property tax was by far the largest form of taxation that local governments relied upon. Today, as we'll see near the end of our discussion here, the average local government in California generates only about 14%, 14% of its revenue from the property tax. So Proposition 13 had a major influence on the revenue distribution of local governments. One of the major problems with the property tax is, going back to the idea of equity, it tends to be a very regressive form of taxation because it is a wealth-based tax. The indicator of your wealth as a taxpayer is obviously the value of your home, what we call the assessed value of your home. The assessed value of your property is the value of the property that is subject to property taxation. Now, there can be a disconnect between the value of your home and your income. And most people are going to pay their property taxes out of their income. They're usually not going to refinance their home in order to pay their property taxes. So if you have a very expensive home, but you have a relatively low level of income, that disconnect is going to make that property tax very regressive and very unfair for you. The way the property tax works is we calculate the property tax based upon two major criteria. Number one, the tax rate, and number two, the assessment rate. So those are the two components that make up the property tax. Now we're talking about the tax rate. Here in the state of California, we express our tax rates in the form of percentages. And so if you have a 1% tax rate, that will be $1 of taxation per $100 of assessed value of the property. So it's a percentage, so it's 1 per $100 of assessed valuation. That's how we tend to do it here in California. Some other states across the country do not use percentages, but instead what they will use is what's called millage rates. And so instead of saying 1% property tax rate, they will say a 10 mil property tax rate. A 10 mil property tax rate is equivalent to a 1% property tax rate, because a mil is $1 of taxation per $1,000 of assessed value. So you can see how it works. 10 mil is then equivalent to 1%. And it's just different terminology that different states use. But we're going to talk percentages because that's what we use here in California. So the tax rate is the percentage of taxation that is applied to the assessed value of the property. Then the second component of the property tax is what's known as the assessment rate. The assessment rate will measure how quickly that assessed valuation can increase year over year. And here in California, as a result of Proposition 13, we have a 2% assessment rate limitation, which means that unless you sell the house or unless you make some major substantial improvements and modifications to the home, your value of your home can only increase by a maximum of 2% per year. So if you want to limit the amount of property tax revenue that a local government can generate, you need to combine a tax rate limitation with an assessment rate limitation. Because you can imagine if you only had a tax rate limitation, so if you only had, say, a 1% limitation on the property tax rate you can charge, but no assessment limitation, then you could just increase the assessed value of the property as high as you want and still generate a lot of property tax revenue. Likewise, if you had an assessment rate limitation, but not a tax rate limitation, then you could just increase your tax rates and go from 1% to 5% to 10% and increase the amount of property tax revenue that you're generating. However, most states combine tax rate limits with assessment rate limits. And when you combine those two things together, you end up with what's known as a property tax levy limit. A property tax levy limit is just the combination of a rate limit and an assessment limit. Proposition 13 is what we call a property tax levy limit. It combines a 1% rate limit with a 2% assessment rate limit. Property tax levy limits are restrictive in terms of the amount of revenue a local government can generate. Because once you have that rate limit combined with an assessment limitation, it means that there's no wiggle room. There's no way that you can generate additional money out of your property tax. So property tax levy limits are restrictive and restrict the amount that can be generated from the property tax. And that's what we have here in California with Proposition 13. That's what a lot of states have. They go by different names, but here it's Proposition 13. In Massachusetts, it's called Proposition 2.5 because that was the rate that was charged under that. Ohio has what they call House Bill 920. So there are a lot of these tax limits that a lot of states put upon their local governments. A major component, obviously, of calculating how much property tax revenue you can generate is going to be that assessed value of the property. Because again, the higher the assessed value, the more property tax revenue that you will be generating. Different states use different approaches to assessing the value of property for property tax purposes. Some states do what they call annual assessment. In an annual assessment, they will reassess the value of all the homes in their jurisdiction, all the property in their jurisdiction on that annual basis, so once per year. Some states are a little bit less frequent with it. There are some states that will reassess every 3 years, every 5 years, every 7 years. It really does depend upon the state. The real question is, what's the basis that you use for figuring out how much this property is worth for the purposes of property tax revenue? How do we come up with this assessed valuation? And this is where states differ again. The most common way in which we calculate the assessed value of property is to use this approach known as the market value approach. The market value approach asks the question, if this property was for sale on the open market, how much would this property sell for? So we set the assessed value of the property at the market value for that property. We oftentimes do that through what's called a comparable sales approach. So we'll look at likewise situated homes in that general neighborhood that have sold in the past year, and we'll use those comparable sales to then come up with the market value of the property that we are trying to assign an assessed value to. And that's by far the most common way in which a lot of states do assessment. Here in California, like with a lot of things, we're a little bit different. Here in California, we use an approach that's known as the welcome stranger approach. And that term welcome stranger is actually a pejorative term. It's kind of like, welcome new person to the neighborhood. Here's a much higher tax bill than what your neighbor has. And the reason why it's called welcome stranger is that we reassess the value of property when that property changes hands. So when that house sells, whatever that house sold for, that then becomes the new assessed value of that property for the purposes of property taxation. The problem with the welcome, there are good things and bad things, but the problem with the welcome stranger approach is that it violates equity. And specifically, it violates a type of equity known as horizontal equity. There are essentially two different types of equity. There's horizontal equity and there's vertical equity. Vertical equity is what we talked about just before when we talked about the idea of progressive versus regressive forms of taxation. Vertical equity would be a progressive form of tax, whereby people with more ability to pay the tax are paying higher amounts than people with less of an ability. That's what we would call vertical equity. Here we're talking about horizontal equity. Horizontal equity says that similarly situated taxpayers should pay the same amount in taxation. So for horizontal equity, if you had two people who owned identical homes next door to each other, same square footage, same number of bedrooms, same amenities, constructed in the same year, under horizontal equity, those two homeowners would have the same property tax bill. That does not happen in the welcome stranger approach. Imagine that the one homeowner purchased their home in 1975 and has lived there ever since. The other homeowner purchased their home in 2022. Again, same exact home, one purchased in 75, one purchased in 2022. The house that was purchased in 1975 may have sold for $20,000. The one that was purchased in 2022 may have sold for $800,000. Those two homeowners are going to have wildly divergent property tax bills. That's an inherent violation of this principle known as horizontal equity. So that's the bad aspect of the welcome stranger approach. The bad aspect of reassessing the value of property whenever that property changes hands. The good aspect, obviously, is that it keeps people from being taxed out of their homes. And so if you're a longtime resident, that person who bought the house in 1975, their assessed value can only go up by a maximum of 2% per year. So it keeps them from being taxed out of their homes. And that was the whole purpose of Proposition 13 and the creation of this welcome stranger approach. Another approach for assessing the value of property is if you have property that generates revenue. So you have an apartment building, then you can value that apartment building based upon how much income you can generate from the rents that are being charged for the apartments in that apartment building. That's what's known as an income-based assessment approach. Again, it's not going to work for a single family home. It's really only going to work for a revenue-generating parcel of property. Another approach is the costing approach, where we simply ask the question, if we had to recreate this home, if we had to rebuild this home under current construction costs, how much would it cost us to rebuild this home, to replace this home? That's a costing type of an approach. So there are different ways in which we can assign the assessed value of property. Here in California, again, we use this welcome stranger approach under Proposition 13. It's also important to note that different states will use what they call different fractional assessments. So even for states that use the market value approach, it doesn't mean that they are going to value the house at 100% of what the house would have sold for. In a lot of states, they will have a fractional discount whereby they will assess the value at maybe 30% of what the true market value of that home is. So if the true market value of the home is $100,000, for tax purposes, the assessed value will only be $30,000. And that then reduces the property tax burden for those individual homeowners. Here in California, we use 100% as our fractional assessment for single family homes. And so your assessed value would be 100% of the sale price of the home when you purchase that home. So we use 100%, whereas some other states have much lower fractional assessment rates. States will also charge different fractional rates depending upon the type of property. It's not uncommon whatsoever to see agricultural property having maybe a 10 or 15% assessment rate as opposed to 100% because that is farmland that is being used in the course of a business. And don't worry about the coefficient of dispersion. We're not going to be measuring that here in this class, but just from a kind of theoretical perspective, the coefficient of dispersion is a measure of how much horizontal equity there is. We hope with your coefficient of dispersion that you're going to see that people in similar homes are going to be paying similar property tax bills. And that's something we violate very badly with our Proposition 13 and our welcome stranger approach. Property taxes tend to be the most hated form of taxation. And very frequently we see these studies done asking people, what's your least favorite form of tax? And year after year, it comes back as the property tax. One of the reasons why the property tax tends to be the most hated form of taxation is for a lot of taxpayers, it's a very visible form of taxation, especially if you don't have your property taxes impounded into escrow. 2 times per year, you're going to get this very large property tax bill coming from the county assessor's office. And the larger that bill is, the more visible that bill is. And so people tend to really not like the property tax very much. And so for that reason, we have seen a lot of governments try and offer property tax reductions to their homeowners, their property owners. These property tax reductions are oftentimes referred to as being circuit breakers. And you'll see this term used a lot in taxation, what's called a circuit breaker. And kind of like your home having a circuit breaker, the purpose of this circuit breaker is to try and protect your homeowners from shock, to try and protect them from the full impact of these property tax rates. So there are ways in which we can reduce the property tax burden for our property owners. Proposition 13 is obviously the most notable circuit breaker in that it does substantially reduce the property tax burden for homeowners here in the state of California. And we'll talk more about that in the next slide. Another example of a circuit breaker is the use of what's called an exemption. Here in California, there is a $7,500 homestead exemption where homeowners can apply to have the first $7,500 of the value of their home be exempt from taxation. And most states have some type of a homestead exemption. The state of Florida has a lot of these exemptions, especially for senior citizens, which makes a lot of sense if you think about the demographics of Florida. But those are, again, meant to try and break the circuit, to try and reduce the burden on homeowners. Then a third type of circuit breaker, a third type of reduction, is what's called an abatement. Abatements are a little bit different in that abatements are negotiated circuit breakers. Typically, they're going to be negotiated between the government and a corporation that has decided to move into that jurisdiction. And so to lure those corporations into the jurisdiction, the government will say, we will abate your property taxes 50% of the property taxes you would owe over the first 5 years. That's just an inducement to then get those corporations to move into the city in order to increase the long-term property tax base for that city. But they typically tend to be negotiated between cities and between private corporations and or developers. The problem there is that they're usually negotiated by cities or negotiated by counties, which oftentimes leaves special purpose governments out of the loop. So governments like school districts, like regional sewer districts or fire districts, they oftentimes don't have a seat at the table during these negotiations over the abatements, but they're affected by the result of those abatements as well, even though they don't have a voice in the decision making. But our biggest circuit breaker by far is Proposition 13. So let's spend some time talking about Proposition 13, why it came about, how it was designed, and then some of the ways we have recently changed Proposition 13 in some really fundamental ways. Proposition 13 was passed by the voters in 1978. It was promoted by the Howard Jarvis Taxpayers Association, passed overwhelmingly in 1978. And the purpose of Proposition 13 was to shield homeowners from being taxed out of their homes. In the 1970s, you had a lot of people moving into California that placed a lot of demand on the housing market. As we all know, with supply and demand curves, the more demand that's placed on a limited supply, the higher that price will go. And so we didn't want long-term residents to be priced out just because everybody was moving to California, kind of the opposite of what we are seeing now. So it's to protect those homeowners with these circuit breakers. The primary circuit breakers under Proposition 13 was a 1% property tax rate limit and a 2% assessment increase limit. So it limited the property tax rate to be charged to 1%, and it limited the amount that the assessed valuation of a property could change up to a maximum of 2% per year. Now, you may be looking at your property tax bill and you might be saying, I'm paying more than 1%. So why am I paying more than 1% if Proposition 13 has a 1% property tax rate limit? And that's an excellent question. The reason why you're probably paying more than 1% is because of local add-ons. So you might have a local add-on for public safety. And so to pay for police or to pay for fire. Your local school district may have passed some bonds to borrow money in the past that, again, adds on to your 1% rate. Your local sewer district probably has done some major renovations to the storm sewer system and has issued bonds that, again, we have to repay as taxpayers. And so your 1% rate may actually be 1.2 or 1.3%. So it's probably going to be higher than 1%. If you live in a development, it may have Mello-Roos taxes. And Mello-Roos is an unusual situation that is really only seen here in California. And it's called Mello-Roos because of the Mello-Roos law. And Mello-Roos taxes are an additional tax on top of your normal property tax rate. And sometimes these Mello-Roos taxes can end up being relatively substantial. That a house that is not being charged Mello-Roos taxes may have a $5,000 a year tax bill. That same house, if it's in a Mello-Roos district and has Mello-Roos taxes, may have $10,000 in Mello-Roos taxes per year. The idea behind Mello-Roos taxes is that whenever new developments are created, those new developments are going to pull more population into those areas. Those new populations are then going to put a strain on the existing infrastructure. So when you build all these houses and all these people move in, especially here in California, you're probably going to have new fire stations because of the wildfire threat. And so you're going to have to pay for those new fire stations. You may have to build new schools to pay for all the kids that are being generated out of all these new homes. And so all those capital projects, all those infrastructure improvements, they need to be paid for somehow. And so they get paid for with these Mello-Roos taxes. So Mello-Roos is kind of a variation on your typical property tax rate and can actually get to be relatively expensive for people who find themselves in those types of Mello-Roos districts. So your property tax rate may actually be well in excess of this 1% limitation under Prop 13. But by combining a 1% tax rate limit with a 2% assessment rate increase, what you are doing is you're creating a property tax levy limit, as we discussed before, and that's exactly what Proposition 13 is. So your assessed value of your home under Proposition 13 will only change if you have sold that home or if you have made some major improvements to that home. If you're making major improvements to that home, you're going to have to pull permits for those major improvements. And so your local government is going to know what those major improvements are. And so they can then use those projects to then increase the assessed value of your home beyond just that annual 2% increase. Years ago in the old house I lived in, we put in a pool. And that pool then increased the value of the house by, I think it was like $50,000 or $60,000. And so those types of major changes can also increase the value of your home. But typically, the value of that home is only going to increase by 2% per year unless it changes hands. And once it changes hands, then it gets reassessed at that 100% of the value that it sold for. We made some changes to Proposition 13 over the years to expand its coverage. So one of the changes we made, it was in Proposition 58 in 1986, where we exempted property that was changing hands between parents and children. And so if a parent would then sell the house to a child, then that child would be able to keep the original assessed value that that parent had on that house. It would not necessarily then default to the sales price on that house. Proposition 193 in 1996 then did the same thing, but for grandparents. And so if grandparents were selling a house to their child, or a child was inheriting that house from the grandparents, the grandchild was inheriting the house from the grandparents, then you didn't have to pay that higher assessed valuation. Then in 2021, just recently, we had Proposition 19. And Proposition 19, we put some limitations on both Proposition 58 as well as Proposition 193. In Prop 19, what we did in 2021 is we required that in order to get this exemption, you would have to have that house be a primary residence. It could no longer be a rental or a second or a third house for that child. In order for that child to get this exemption, it would have to be that child's primary residence, and they would have to prove that it was their primary residence. And then we also put a value on the home that was changing hands between parent and child or between grandparent and grandchild, and we limited that to $1 million in valuation. So it had to be the primary residence with a valuation of less than $1 million to then qualify for these exemptions that came in Prop 58 and Prop 193. Then another thing that we did in Prop 19 is for Californians 55 years of age or over, or for Californians who have disabilities or were directly impacted by a wildfire, they were given the ability to transfer their Prop 13 assessed valuation from their old home to the new home that they were purchasing. And they could do that up to 3 times during their lifetime. So if you had a home that was valued at $700,000 and you're going to go and buy a home that's valued at $1 million, we'll say $900,000, then you can't take that $700,000 and apply it to the $900,000 home, but you can take a fraction thereof. And so that's something that, to tell you how old I am, I just qualified for this. And I also just recently sold a home and bought a home. And it substantially reduced my property tax bill, paying on about $200,000 less valuation on the new home as compared to the previous home. Again, that's for people over the age of 55 who have disabilities or were directly impacted by a wildfire, meaning that their house burned down or is no longer inhabitable. then they also qualify for this exemption. So that's Proposition 13. That applies only here in California, thus making our property tax system relatively unique when compared to states around the country. There have been some calls to further revise Proposition 13. And one of the ways in which some people want to revise Proposition 13 is to do what's called a split roll initiative. Proposition 13, as it was originally written, applied to both residential property as well as business property. Some people say it should not apply to business property, it should only apply to residential property. So in the split roll initiative, what they want to do is they want to separate it so that Proposition 13 protections would still apply to residential property, but would no longer apply to business property. That's what's called a split roll. That initiative went down to defeat in 2020, so the voters did not approve that. There's a chance it may come back before the voters again in 2024. So you may see on your ballot in another year or so this split roll initiative to divide residential and business property for the purpose of Proposition 13. But you really can't overemphasize the impact that Proposition 13 had here in California on property taxes and property tax revenue generation. That's the reason why the average local government here in California now relies more on user fees and user charges as opposed to property tax revenue, because it greatly limited the ability of local governments to generate property tax revenue. So they then had to look for other revenue sources, and they found those other revenue sources with user fees and user charges. So just quickly to wrap this up, and then we'll take a short break for tonight. Let's go back and look at the property tax in terms of our evaluative criteria of taxation. In terms of burden distribution, it is a wealth-based tax. So that makes it an ability to pay tax because we are taxing you based upon the assessed value of your home. We may have some circuit breakers built in there for people from lower incomes and for older residents, but for the most part, you're paying the vast majority based upon the value of your home. So that does tend to make it a wealth-based type of tax. As such, it does have the potential for being highly regressive and violate, as we talked about before, this principle of horizontal equity. Two similarly situated taxpayers are probably going to end up paying wildly different property tax bills because of when they purchased their homes. It is a very adequate and stable form of taxation, as we talked about before. That's why local governments tended to use it primarily in the past. It's a collectible type of tax, especially when you have property taxes rolled into escrow and impounded, because this goes into your monthly mortgage payment, and it's a very taxpayer passive type of tax. If the tax is not impounded, then it becomes very taxpayer active in that the taxpayer needs to actually remit this property tax payment twice per year to the assessor's office. So it's kind of a mix in terms of collectability. But it does tend to be a very collectible form of taxation. Give you an example that whenever we talked about bonds last week, we talked about bond ratings, whenever a government goes out there to get its bond rating from Standard & Poor's or Moody's or Fitch's, one of the questions those rating agencies will ask will be, what is the collectability in terms of your property tax levy? How much of your property tax levy do you collect? So are you collecting 95%? Are you collecting 97% of the money that is owed to you from property taxes? The standard that those companies are looking for is a 97% standard. That it's a red flag if governments are able to collect less than 97% of the property tax levy owed to them. That's going to be a major red flag, and that's actually going to then hurt their bond rating. So we usually expect 97% collection rates. And as we talked about before, the property tax tends to be much more insulated from economic fluctuations because people are always buying homes, and it's the American dream. And so it's not nearly as tied to economic fluctuations as income taxes would be or as consumption-based taxes would be. But that's our first form of taxation. Property taxes is a domain primarily of local governments here in the US. It is 7:15 according to my clock, or thereabouts. So I think it's probably a good time to take a break. So let's go ahead and we'll say about a 10-minute break because we still have a lot of information to cover. So come on back at 7:25, and then we'll talk about income taxes, sales-based taxes, and then our final topic will be non-tax sources of revenue, user fees, and user charges. So come on back at 7:25, and we'll jump into income taxes. Okay, it is 7:25, so we are back, and let's talk about income taxes, sales taxes, and then we'll see what we're looking at time-wise. And if we have enough time, we'll do non-tax sources of revenue. And if we do not, then we can always push that topic to the beginning of next week's session. So our second main form of taxation, obviously, is income taxes. As we know, income taxes tend to be the primary source of revenue for the national government, but also used predominantly also at the state level as well. In some states, the income tax is also available to local governments. Now, we don't see that much here in the state of California, but in a lot of states, cities, sometimes even school districts have access to income tax revenue. And so again, our system of federalism gives us a lot of different variations in the tax structures and which taxes are used by which forms of government. The income tax tends to be viewed as being much more progressive than the property tax because of the use of these graduated marginal income tax brackets. So we have graduated marginal income tax brackets whereby people with higher levels of income will pay a higher percentage in taxation than those with a lower income level. Also, we have these marginal tax brackets, which then allow us to not tax our taxpayers all their income at one level. So what we can do is we can say up to a certain amount, your income tax rate will be 10%. And then for every dollar above that, then it will be at 12%. Then from every dollar above that, it goes to a higher rate, and so on and so on. We use those graduated marginal tax brackets not only at the federal level, but we also use them here in the state of California. And in fact, here are some examples. They're about a year or so old, but here's an example of graduated marginal income tax brackets at the federal level. You'll see your rates on the left, then you'll see your filing status, single, married, filing jointly, head of household. I didn't include married filing separately, but those are different filing statuses. And then you'll see, so for up to the amount of $9,875 for a single taxpayer, they will pay a 10% tax rate. Then for every dollar above $9,875 up to $40,125, every dollar would then be taxed at 12%. And then for every dollar above $40,125 up to $85,525, each one of those dollars will then be taxed at the 22% level, and so on and so on. The nice thing about having graduated marginal income tax brackets is it does make the income tax look a lot fairer and a lot more equitable to taxpayers. And that's why whenever we ask taxpayers what their favorite and what their least favorite forms of taxes are, as we said, the property tax tends to be the least favorite. The most preferred form of taxation tends to be the income tax because of all of these marginal tax brackets. And here in the state of California, we also have a graduated marginal tax bracket system. Same type of idea. You can see the tax rates running from a low of 1% up to a high of 13.3%. So similar type of situation between the national as well as the state government. Most states will piggyback their income tax systems on the federal system. And so they'll take your national tax liability and your national adjusted gross income, and they'll then use that as the starting point for calculating your state income tax liability. Now, the starting point for calculating your tax liability will be this thing called the AGI, or the adjusted gross income. Then off of that adjusted gross income, we will then add on the circuit breakers to reduce the tax burden for income taxpayers. So some of the major categories of circuit breakers or income tax reductions that we tend to see things such as, let me move this out of the way from, okay, things such as deductions. We hear a lot of talk about deductions as tools to decrease your income tax liability. Deductions are powerful tools, but they're not the most powerful circuit breaker. They're not nearly as powerful as what we call a tax credit. But the way in which a deduction will work is a deduction will come, most of the deductions, not all, but most of the deductions will come off of your adjusted gross income. So deductions are there to try and adjust for filing status. And so you'll have one standard deduction if you are filing as a single taxpayer, another standard deduction if you're filing as married filing separately, another one if you're married filing jointly, and another one if you're filing as head of household. And as a head of household is usually reserved for those taxpayers who are either senior citizens or taxpayers with demonstrated disabilities. And those are the ones who tend to be able to file as head of household. So it adjusts for your filing status, whether you're single, married, so on and so on. There is a standard deduction, and that standard deduction for each of those different filing categories was greatly increased with the Tax Cuts and Jobs Act under the Trump administration in 2017. And the purpose for greatly increasing the value of the standard deduction is to try and incentivize more and more people to claim the standard deduction. So if you claim the standard deduction, you will not itemize deductions such as the interest you pay on your home mortgage. You will not itemize deductions such as your donations to charities. Itemize deductions such as medical expenses. Just take that standard deduction. You'll then subtract that standard deduction from your adjusted gross income, which will then lower the amount of income that you need to pay income taxes on. If you do not own a home or you do not have a mortgage, if you do not have a large amount of medical bills, if you don't give a large amount of money to charity, you'll probably claim the standard deduction. If the value of all your itemized deductions add up to more than the value of the standard deduction, that's when you'll go ahead and itemize your deductions. Allowing for people to itemize their deductions is usually intended to try and encourage certain types of behaviors. So we want to encourage people to buy homes. And so we allow them to deduct the amount of interest that they pay on their home mortgage. It incentivizes them to buy homes. We want people to give money to charity. And so by allowing people to deduct their charitable contributions, we are encouraging that type of behavior. Not only do we use deductions to encourage certain types of behaviors, we also use deductions in order to try and make sure we are taxing people on their, essentially their net income. And so there are other things that you can itemize, such as if you have some job retraining costs that are required as part of your job. In order to keep your job and remain employed, you have to pay for these job retraining costs. Some of those can be deducted from your adjusted gross income. If you are forced to move as a result of your job, you may be able to deduct some of those moving expenses as well. Now, that's if you're being forced to move as a condition of your job, not just you're deciding to move to another state. So there are a lot of reasons why we allow people to itemize their deductions. Again, if they have a higher value from itemized deductions, they'll do that. If the itemized deduction value is less than the standard deduction, then they will just claim the standard deduction. So we have a lot more people just claiming the standard deduction, and the purpose there is to try and simplify the tax filing process. The more you itemize, the more complex it becomes, the more likelihood that you're going to have somebody help you file your taxes, the more mistakes tend to be made whenever you itemize your deductions. And so we try and want to get as many people to avoid that as possible. That was the purpose of the Tax Cuts and Jobs Act. Then another provision of that Tax Cuts and Jobs Act was in exchange for increasing the value of the standard deduction, it then also eliminated these things called exemptions. So prior to 2017, you could claim exemptions depending upon your family size. And so if you had a family of with 4 children, you yourself, a spouse, and 4 children, you could claim 6 exemptions. And then there is a dollar value associated with each of those exemptions. So each of those exemptions could be worth $3,500. And so that would then come directly off of your adjusted gross income, thus lowering your overall tax bill. Those exemptions were eliminated in the Tax Cuts and Jobs Act, again, in exchange for this larger value for the standard deduction. Another very controversial change that came out of that act in 2017 was limiting what's known as SALT. And SALT is the state and local tax deduction. So you can also, if you itemize your taxes, you can deduct the amount of taxes that you pay to state and local governments. That is an artifact of this whole idea of reciprocal tax immunity that we had talked about last week. So you could deduct those taxes you pay to state and local governments. That was capped at $10,000 in 2017. And what that has done is it's greatly increased the tax bill for people who live in high tax states such as California and New York. So there are always calls in Congress to get rid of that cap on the SALT deduction, but as of now, that SALT deduction is still part of our tax system. So deductions are very powerful tools in order to reduce your overall tax burden, but tax credits are even more powerful. And the reason for that is where tax credits are applied in the tax paying process as compared to where deductions are applied. Deductions are subtracted from your adjusted gross income. They are subtracted from your income before you calculate your tax liability. So if your adjusted gross income is $100,000 and you have $30,000 in itemized deductions, then your adjusted gross income for the purpose of taxation will then be reduced to $70,000. And then you'll calculate your tax liability by then multiplying your prevailing tax rate to that $70,000, which will then give you your tax liability. However, tax credits are different. A true tax credit will come off of your tax liability. So you calculate your tax liability, and then you subtract that tax credit directly from the amount of money that you owe to the federal government. So let's say on that $100,000 of adjusted gross income, you then can take off your $30,000 in deductions, you end up with $70,000. And then when you calculate your tax liability, you see that you owe, say, $3,000. You have a $3,000 child tax credit. You subtract that $3,000 from your $3,000 liability, and you end up with a liability of $0. That's why tax credits are so powerful, because they come directly off your tax liability as opposed to coming off of your deductions, off of your adjusted gross income before you calculate your liability. So tax credits are very, very powerful tools. The problem is that we oftentimes refer to deductions as credits, and that really complicates the whole tax paying process. To know if something is a deduction versus a credit, you have to know when it is applied. If it's applied, subtracted off your adjusted gross income, it's a deduction. If it comes directly off of your tax liability, then it is a true tax credit. But those are all circuit breakers to try and reduce the burden of taxation that taxpayers pay as a result of the income tax. So those circuit breakers are very helpful. And again, they make the income tax much more palatable, if you will, to taxpayers. The problem with these circuit breakers, like deductions and like credits, is that it introduces a lot of confusion into the system, and that people don't know what deductions they qualify for. They'll start claiming deductions that they really don't qualify for. Some people, and this is one of the major problems we oftentimes see in tax returns, is that people will apply for what's called the earned income tax credit when they don't actually qualify for that earned income tax credit. One of the most powerful tax credits we currently have is what's known as the EITC, the Earned Income Tax Credit. The Earned Income Tax Credit is there to help what referred to by tax professionals as working poor. So people who are fully employed, but who are not making a high income. And so depending upon your family size, there will be income thresholds that will qualify you to then claim this earned income tax credit. Earned income tax credit is a true tax credit, so it comes directly off of the tax liability that you owe. The problem is sometimes people claim it even though their income exceeds the eligibility levels for income. So they'll make more than what you're allowed to make in claiming the EITC. One of the major red flags for an IRS audit is claiming the earned income tax credit. So whenever a return comes into the IRS and they see that the earned income tax credit was claimed, they're going to look more closely at that tax return to make sure that person actually qualifies for the earned income tax credit. The problem there is that has meant that audit rates for lower income taxpayers is artificially inflated or are artificially inflated, and that you have sometimes more of a probability of being audited by the IRS if you're a lower income taxpayer who claimed the earned income tax credit than if you are a high wealth individual who claimed a bunch of other types of deductions and credits. And so sometimes it leads to higher audit rates for lower income individuals. There is a problem known as lack of indexation. Indexation is when we change the values of deductions and credits each year to keep up with inflation and the changing value of money. Congress has been very poor up until very recently at engaging in indexation. So they will create a value to deductions, they'll create a value to these tax credits, and then those values remain the same year after year, even though the value of money has changed. And those values should be increasing, but instead they're remaining static. Now, some of that was taken care of with the Tax Cuts and Jobs Act in 2017, where he began indexing some of these deductions and some of these credits so that their value grows each year, usually tied to inflationary factors or tied to the consumer price index. So we've started doing a better job with indexation. But for many years, we just did not index these deductions and credits to keep up with the value of inflation and changing value of money. Another major problem is what's known as the alternative minimum tax, or the AMT. The alternative minimum tax was originally designed to make sure that high income taxpayers paid at least a certain percentage of their income in taxation. Obviously, higher income wage earners are able to get the best tax preparers. They can pay for those tax preparers. And so therefore they find a whole bunch of deductions and a whole bunch of credits that sometimes can reduce their tax bill down to zero, or maybe even allow them to get a refund, even though they're a very high wage earner. The idea of the alternative minimum tax is to make sure that a lot of these deductions and credits go away for high income wage earners. So once your income gets above a certain amount, you will then be subject to the alternative minimum tax, which means you lose your deductions and you lose a lot of these credits to make sure that you're at least paying a certain amount in income taxation. So there's nothing wrong with that idea. The problem was that Congress never engaged in indexation for the alternative minimum tax. So when it was first designed, the alternative minimum tax was supposed to affect only the top 1% of wage earners. Because wages increase year after year after year, and they didn't change the alternative minimum tax, you ended up ensnaring a whole lot of middle income taxpayers into this alternative minimum tax trap. And they ended up losing their deductions and credits, and their tax rates skyrocketed under this alternative minimum tax. In 2017, in the Tax Cuts and Jobs Act, they changed the alternative minimum tax so that they exempted more and more middle-class wage earners from that alternative minimum tax to kind of make it look and feel a lot more like it was designed to look and feel, only affecting higher income wage earners. So some of these problems have been taken care of as of 2017, but we still have a very convoluted, very confusing tax system that a lot of people are able to manipulate in order to pay less than what we would consider to be their fair share in income taxes. Then as part of income taxes, you then also have these things called payroll taxes. And payroll taxes are taxes for programs such as Social Security and Medicare. Payroll taxes go directly to fund Social Security Trust Fund as well as the Medicare Trust Fund. And the way in which they work is that the Social Security tax rate is 6.2% on income up to $147,000. Medicare tax rate is 1.545%, again, on that first $147,000 of income. So if you are working for multiple employers and the combination of your income goes above $147,000, you'll probably end up getting a refund in terms of the amount of Social Security taxes that you paid, because your second or third employers don't necessarily know what's being withheld from the paycheck paid by your first employer. And so a lot of people with multiple employers end up paying more than they should in Social Security taxes, and then end up having that refunded to them whenever they file their taxes on April 15th. But again, these payroll taxes are meant to try and keep the Social Security Trust Fund and the Medicare Trust Fund solvent for as long as possible. A lot of people don't understand Social Security and the way in which Social Security actually works. A lot of people like to think that there is an account with their name on it, and then all these payroll taxes for Social Security come out of their check and then go into their account. And that's not the way in which it works. People who are currently in the workforce now are paying for the benefits that are being collected by people who have already retired. And then when people who are in the workforce now end up retiring, then it will be a future generation's wages that will then pay for their benefits. And so it's very much a redistributive program. And a lot of people don't realize just how redistributive Social Security really is. But those are what are known as payroll taxes. So to kind of sum up income taxes in terms of our 5 evaluative criteria, in terms of burden distribution, obviously it's very much an ability to pay tax. We gauge someone's ability to pay by their adjusted gross income. In terms of equity and fairness, the marginal tax brackets, graduated marginal tax brackets, provide us with the impression of progressivity. And to some degree, it is a progressive type of tax. But because of all the myriad of loopholes in the tax code, sometimes that's not the reality. And we've all heard the stories of billionaires who pay less in tax burden than the people who work in their offices. And Warren Buffett is very famous for saying that his tax rate actually was less than the tax rate paid by his personal secretary. That's because of all those tax deductions and all of those credits. Adequacy, the income tax is a very adequate tax. That's why the federal government relies almost exclusively on it. It tends to be a collectible tax through withholdings, but then once it becomes more taxpayer active on April 15th, it becomes a little bit less collectible. And that's why we've had this big debate going on in Congress about all this money that is going to the IRS for enhanced enforcement. And the Biden administration came out and said, well, that's only good for people who are making more than $400,000 a year. And our debt ceiling negotiations, we saw some of that money being peeled back by Republicans in Congress. And so there's always this discussion going on about just how much enforcement the IRS should do in order to increase the amount of tax revenue coming in from the income tax. Economic effects, the income tax does have an impact upon the economy in terms of what we talked about before, this work leisure type of decision. And the economy obviously is going to have an impact upon income tax revenue. When people are out of work, they don't have income coming in. They don't have income coming in. There's nothing there for government to tax. And then our third form of taxation are consumption-based taxes. And with consumption-based taxes, obviously, we are shifting our focus from an ability to pay to a benefits received type of principle. You can have general consumption-based taxes, such as a general sales tax, or you can have specific types of taxes, such as selective excise taxes. A general sales tax will apply to the broad range of commodities that are transacted within a jurisdiction. So it will apply to all these transactions. A selective excise tax is much more specific, and it will only apply to specific types of transactions. Examples of selective excise taxes, these specific taxes, are things such as a luxury tax, a sumptuary tax, and a benefit-based excise tax. A luxury tax, an example of that could be a tax on yachts. And so you're going to apply this tax to luxury items that are being transacted. The idea being that if you're going to have a yacht tax, then the burden will then be shifted onto upper income individuals, people who have the financial wherewithal to go out there and purchase these yachts. In theory, that's a good idea. The problem, obviously, is that there are externalities, there are spillovers from that type of a luxury-based tax. That if you are increasing the price of yachts, then people are going to perhaps stop buying the yachts. If they stop buying yachts, then there'll be less need for a supply of yachts, which means it's going to hit those people who are working in those shipyards who are building those yachts. And so the actual impact of this luxury tax may actually trickle down and impact those people who are working in those shipyards. And those are the people you do not want to impact with this type of a luxury tax. So it can kind of be dicey in terms of impacting the taxpayers you want to impact with your luxury tax. Sumptuary tax are also known as sin taxes. So sumptuary or sin tax would be a tax on tobacco, a tax on alcohol. These types of sumptuary taxes are oftentimes preferred by taxpayers because they allow taxpayers to engage in burden shifting. So if you do not consume tobacco products, you don't pay the burden of this cigarette tax. So you can shift the burden onto someone who does consume tobacco products. So because whenever you allow burden shifting on the part of a taxpayer, those taxpayers tend to prefer those types of taxes for obvious reasons. Then the third type of selective excise tax is a benefit-based excise tax. So a great example of that would be the motor fuels excise tax. You are taxing people based upon the benefit that they are getting from purchasing whatever they are purchasing. And so if they purchase gasoline, the benefit they get is they are going to drive on the roads. By driving on the roads, they are going to cause wear and tear on the roads. And so we will capture this motor fuels excess tax revenue, and we will put it into our highway trust fund to then pay for the construction and the reconstruction of these roads. Those are benefit-based types of excise taxes. Again, capturing that money and then earmarking it for that specific type of expenditure. Now, again, these consumption-based taxes, because they do not on face value take into account the ability of the person to pay the tax, can end up being highly regressive in nature. Since they tend to be very regressive forms of taxation, we have to be as proactive as possible as governments to try and make them less regressive and more progressive. And the way in which we do that is oftentimes through these things called commodity-based exemptions. So we will exempt some of the staples of life from the coverage of this consumption-based tax in order to try and shield our lower income citizens from having too much of this burden of consumption-based taxes. So we will exempt things sometimes such as food. We'll exempt things in some states such as clothing. We will exempt pharmaceutical medication, prescription medications. And we really have to try and devise the right set of commodity-based exemptions to take what is normally a regressive form of taxation and try and make it a little bit more progressive in nature. Some other considerations that we talk about a lot in terms of consumption-based taxes like the sales tax is a variation on a consumption-based tax known as a value-added tax or a VAT. A VAT is a specific type of sales tax that applies at every single point in the production process where the value of a commodity increases. Now, this value-added tax is something that is used in a lot of European economies, but we do not currently use it in this current manifestation here in the United States. But the idea behind the value-added tax is that at each point in the production process, value of that good increases, you then apply a tax rate to the value of that product at that point in the production process. So when you think about when something goes from the raw material phase to the manufacturing phase, it increases in value. So you assign a tax rate, you assign a tax to that manufacturer. Then when it goes from the manufacturing stage to the wholesale phase, you then assign taxation to that wholesaler because the value's increased. When it goes from the wholesale to the retail phase, you then apply taxation to that retailer because, again, it is now increased in value. And then whenever a consumer walks in the door and purchases that good, it increases in value again. And so you apply another instance of taxation onto that consumer. The idea, obviously, behind the value-added tax is you shield your consumer by spreading the tax burden out throughout the entire production process. The obvious problem there is this idea of burden shifting. So we have quite the instance of forward burden shifting. Put that in text check. Forward burden shifting, where the tax rate, the tax incidence, if you will get shifted forward throughout the production process. So obviously these manufacturers are then going to compensate for this higher taxation by increasing the price for the wholesalers, who will then increase the price for the retailers, who will then end up increasing the price for the consumers. So oftentimes at the end of the day, it's still the consumer that's getting hit with the impact of this value-added tax. So it's a good idea in principle, but in practice, because of forward burden shifting, it oftentimes just does not work. And it's still the consumer that's paying the primary burden for this form of taxation. Another interesting discussion that we have been having now for a couple of decades is this idea of the ability to tax internet sales. We know that we have now shifted from a brick and mortar type of retail environment to an online retail environment. And so the question's always been, how much access do state governments have for taxing these transactions that happen in e-commerce online? For years, the guiding principle that really guided internet sales taxation came from a case way back in 1992 called Quill versus North Dakota. And you might be thinking to yourself, 1992, how much e-commerce was going on in 1992? And you're right, very little. And that's because this case was a case of a stationery company known as Quill Stationery and the Department of Revenue of the state of North Dakota. So without getting too much into the weeds here, Quill Corporation was a stationery company that was based in the state of Minnesota. It had a mail order catalog business whereby it was selling its stationery to citizens in other states. And so it was selling its stationery to citizens in North Dakota. North Dakota Department of Revenue said, we should be able to tax those transactions because they're transactions that are being conducted with residents of North Dakota. Quill Corporation said we should not be subject to the North Dakota tax rate because we are not located in the state of North Dakota. The Supreme Court in Quill versus North Dakota established this principle known as a physical presence nexus. And what the court said is that corporations must have this physical presence nexus in the state that wants to charge the taxation. So in order for North Dakota to charge its sales tax rate to transactions conducted between Quill Corporation and residents of North Dakota, Quill Corporation would have had to have a physical presence within the state of North Dakota. Quill Corporation did not have a physical presence in North Dakota. Their only presence was from these mail order catalogs that were being mailed out. So therefore, North Dakota did not have the ability to tax these transactions. That physical presence nexus is a legal principle that then existed for almost 30 years and governed the ability of state governments to tax remote sales, and was then extended to include the logic that was applied to e-commerce online transactions. It wasn't until recently in the Wayfair case that the Supreme Court kind of changed its mind. And the Wayfair case, the Supreme Court threw out the Quill precedent, and the Supreme Court said you do not have to have a physical presence nexus in the state for that state to charge taxation on the transactions that were being transacted between this remote seller and the citizens within the state. So it really threw the doors wide open for state governments to start taxing online transactions. and really opened up a huge pot of revenue for a lot of state governments. But this didn't happen overnight. Again, this was like almost 30 years later. And it was the result of a lot of work on the part of state governments. After the Quill versus North Dakota case, states started to get together to try and come up with and brainstorm a way in which they could tax remote sellers. And that process became known as the Streamlined Sales Tax Project. So all these states got together, tried to come up with uniform legislation that could then be passed by each one of the individual member states that would then allow them to tax remote sellers. They made some progress in that regard, and they lobbied Congress, and they were finally able to convince Congress and to convince the courts that they could levy taxation on remote sellers without costing these remote sellers a lot of money. So they put together an electronic database so that sellers knew exactly how much the tax rates were in all these different states. They produced what they called a zero cost compliance burden on corporations. So corporations didn't have to bear any of the burden of collecting and remitting this taxation to the state. All of that would then be borne by, all those costs would be borne then by those states. And all that then kind of, as I said, convinced Congress and convinced the courts to then allow state governments to have access to taxing online sales. Even when states were not allowed to apply their sales tax to transactions with remote sellers, they were still able to apply this thing known as a use tax. We have 45 states that currently have a state sales tax. And in all 45 of those states, they then also have what is known as a use tax. The use tax was utilized whenever the state could not apply its sales tax. So under the old Quill standard, they could not tax transactions between their residents and these remote sellers, these sellers that did not have a physical presence within the state. But what they could do is they could charge their residents a use tax. The use tax is charged on the value of a good that you purchase, then bring into your home state and consume within your home state. So if you're bringing it into your home state, you're using it in your home state, you're consuming it, then there is a use tax applied to the value of that good that is being consumed. If you complete your own California state income taxes, you'll know that on your state income tax form, there is a line where you are asked to declare the use tax. So you declare the value of goods that you purchase out of state and then brought into California and consumed within the state of California. And you are technically required to then pay that use tax. Now, how many people pay that use tax? I'm not asking you to rent yourselves out, but how many people actually pay that use tax? Very few. And many years ago, I did a study looking at 5 different states and the amount of revenue that they were collecting from their use tax. And I found that use tax compliance rates were somewhat less than 0.0001%. 0.0001%. Think about that for a second. I mean, that means that's literally less than pennies on the dollar that states were collecting from their use tax. So the use tax is not a great source of revenue for states, but it's there in case the state is precluded from applying its sales tax rate. So let's be aware that if a state has a sales tax, it also is going to have this thing called a use tax. It's just compliance is very hard to ensure with that use tax. So sales and consumption-based taxes, how do they then relate to our 5 evaluative criteria for taxation? Well, in terms of burden distribution, as we said, they're very much benefits received types of taxes. We are taxing people based upon the value of the benefit they get from consuming this good or service or commodity. We also said that naturally they tend to be very regressive in nature because we are not taking into account the ability of the person to pay the tax. And so they tend to be regressive and have a bigger impact upon lower income as compared to higher income individuals, because lower income individuals have less disposable income. We need to design the right set of commodity-based exemptions in order to try and take what is naturally a regressive tax and try and make it a little bit more progressive in nature. Adequacy, consumption-based taxes tend to be very adequate. That's why we see state governments rely upon them. That's why a lot of states allow their local governments to have access to what's called a local option sales tax. And we see that here in California, where we have a local option sales tax whereby counties can then add on to the basic level of the state sales tax. So you have a lot of variation between counties in terms of their sales tax rates, but it tends to be a very adequate form of taxation. It also tends to be the most collectible of all of our forms of taxation because you're collecting this revenue from a limited number of vendors as opposed to an unlimited number of individual taxpayers. But on the downside, it is the most closely tied to the economy. That the sales tax will have a price effect and will then have an impact upon economic activity. And then likewise, poor economic times will mean that there are less commodities being purchased, which means there's going to be a reduction in sales tax revenue. If you're familiar with the Laffer curve and you're familiar with this curve in which it's kind of like that hump whereby as you increase your sales tax rate, you're going to generate more, I'll do it like this, you're going to generate more and more revenue up until you get to a point of critical mass. At that point where your sales tax rate becomes too high, it raises the price of the commodity too much, people are going to stop consuming it, and then your sales tax revenue is going to go down. So it's really important to find that sweet spot in terms of the right sales tax rate that won't have an impact upon the consumption of that good or that service. Now, obviously with sumptuary types of taxes, sin taxes, we oftentimes sell those sin taxes on a kind of hypocritical basis in that we sell them to voters saying, here is a way in which we can generate a lot of additional revenue and you're not going to have to pay it because you don't consume alcohol or you don't consume cigarettes. And so you're not going to have to pay that tax. So we're going to generate a lot of revenue. The problem, though, is if you're going to generate a lot of revenue, you are assuming that you're not going to depress consumption, that people are going to continue to pay for cigarettes and alcohol, irrespective of the increase in the price. If there is an increase in the price and it's a very elastic good, then by increasing your sumptuary sales tax, your sumptuary tax rate, you're going to actually depress consumption. And it's not really possible for you to both increase revenue at the same time depress consumption for what's considered to be a socially undesirable type of behavior. Because that's the other way in which we sell sumptuary taxes, is that when we're going to keep people from drinking, we're going to keep people from consuming tobacco products. Well, you can't have them both. You can't decrease consumption at the same time increase a lot of the revenue that you're generating. They kind of are mutually exclusive to each other. So sometimes we've been a little hypocritical in selling these sumptuary taxes to our voters. So on this next screen, you'll see the distribution of revenue sources. Let me move this out of my way. The distribution of revenue sources based upon what cities get the most revenue from, where they get the least revenue from. You'll see one thing that will probably jump out at you right away is on the right side of this chart, you'll see property taxes at 14%. Again, prior to Proposition 13, that number would have been inverted. It would have been about 41% of revenue coming from property taxes, but because of limitations from Prop 13, that number now is 14%. So see, 14% coming from property taxes, 7% coming from local option sales taxes, 2% from business licenses, 3% from the utility user tax. The transient occupancy tax is a hotel tax. And again, depending upon the cities, some cities get a lot more money from their hotel tax than other cities, but on average, you get about 2% from hotel taxes. You'll see revenue coming from franchises, revenue coming from state and federal governments. And then on the left side, you'll see where a lot of the revenue comes from, especially revenue that is restricted in nature. That's utility fees and charges, that's 29%. Added to that, other fees, miscellaneous fees, another 12%, developmental fees, 2%, licenses and permits, 1%, fines and forfeitures, 1%, investments and rents, 1%, intergovernmental grants, 9%, 5% from the federal government, 4% from state governments, 3% for special taxes, earmarked taxes that are going for specific types of purchases, 2% for benefit assessments. I know we had talked about this before. If you create an assessment district, you charge a higher rate to that assessment district because they get more of a benefit from those streetlights than people who don't live within that area. That would be a benefit-based type of assessment. But you can see a lot of the revenues coming from user fees and user charges as opposed to coming from your traditional sources of revenue. And that is a major change. If you were looking at this chart prior to Proposition 13, everything would probably be inverted prior to Proposition 13. But because of the limitations from Proposition 13, local governments had to start looking elsewhere. They really had to diversify their revenue portfolios. And the way in which they diversified their revenue portfolios, looking at revenue from non-tax sources such as user charges and user fees. Now, this is where the nomenclature becomes a little bit confusing. In a practical sense, governments oftentimes talk about user charges and user fees synonymously, in that they're basically the same thing. And you'll oftentimes see them say user charges / user fees. However, Mike Sell points out, and I think he makes a really good point, that there is a difference between what is a user charge and a user fee. They are both considered non-tax sources of revenue, but user charges tend to be derived from the consumption of some type of a service. So when people consume a service, they are charged for the value of that service that they are consuming. That is a user charge. So user charges usually tend to be attached to the consumption of some type of a service, the benefit you get from consuming that service. User fees, there's usually not a particular service that is being consumed. User fees oftentimes come from things such as licenses. And so governments will issue licenses and then charge a fee attached to those licenses to then help them not only raise revenue, but help them control who engages in a certain type of behavior and how those individuals will engage in that behavior. So you think about something like you get a driver's license. You have to pay a fee for that driver's license because essentially you'll take that driver's license and you're then going to drive on the road. So we can then regulate how you drive on that road. And so if you're an unsafe driver, if you get busted for DUI, we can take that license away from you. If you want to hunt, you have to get a hunting license and pay a fee for that hunting license. And we can then regulate how you then hunt, what time of year you hunt, the types of animals you hunt for. Same type of thing with a fishing license. If you want to open up a franchise, you'll probably have to get a franchise license and pay a franchise fee so that we can regulate who opens up franchises and then how those franchises operate on a daily basis. So charges are connected to the consumption of a service. Fees typically are not. They're more attached to licenses and the privilege of engaging in a certain type of a behavior. But again, that is kind of the classroom theoretical difference between the two. But on a practical level, most local governments will just talk about them as interchangeable terms. So a lot of governments look to these non-tax revenue sources because they needed to, number one. But number two, they were also more acceptable to citizens because they're just that, they're non-tax sources of revenue. And so people can choose whether or not to consume a service and choose whether or not to pay that user charge. They can choose what they want to behave in and choose whether or not to then pay that fee that's attached to that license. Again, the more you can shift the burden, the more likely citizens are going to be supportive of that revenue source. But you'll notice on that previous slide, local governments are still reliant upon different sources of tax revenue because you are never going to be able to completely supplant your tax-based sources of revenue with non-tax sources of revenue because there are limitations on what you can use these user fees and user charges for. In order to use a user charge, you need to have some components of a private sector good. You need to be able to separate the benefit that people are getting from consuming this service. If you have benefit separation, it's going to be difficult for you to charge according to the benefit that people are getting from consuming the service. You really need to have that chargeability mechanism. In order to have that chargeability mechanism, whatever good or service is being consumed, exclusion needs to be feasible. You need to be able to exclude people who are not paying for that good or that service. If you don't have that chargeability and that excludability feature, those private sector types of features, chances are you're going to have to fund that with a tax-based source of revenue as opposed to funding it with a user fee or a user charge. So we are limited in the amount of revenue we're going to be able to generate through user fees and user charges. We also have to remember that there are spillover effects. And so if a service, the consumption of a service has spillover effects, externalities, as we call it in the world of economics, it's going to be less likely you're going to be able to utilize a user charge because you're going to have a lot of free riders, a lot of people who are getting benefits from this service, but they're not then paying for it. And it's hard to identify exactly who's getting a benefit and how much benefit that they are getting. What this basically means is that redistributed programs typically do not work well with user charges and user fees. Redistributed programs tend to be paid for with tax-based sources of revenue, and then regulatory programs and distributed programs are the ones that tend to work better with a user fee or a user charge. Since the majority of our programs tend to be redistributive in nature, we will never be able to fund all of our programs 100% with non-tax sources of revenue. So the moral of the story and the bad news is we're always going to be living with taxation regardless. Some of the programs that tend to work really well with user charges are, again, those that have benefit separation, those that have chargeability, things such as household supports. And so trash collection has a user charge associated with it because you can then measure the people who are using it versus people who are not using it and then charge them accordingly. Much like our break-even analysis that we talked about a couple of weeks ago, that was the example of utilizing a user charge for that type of household support. Industrial development supports also tend to work relatively well with user charges. Again, the more redistributive the program, the less likely it is that you'll be able to pay for that program with these non-tax sources of revenue. Then another non-tax source of revenue that kind of crosses over with user charges a bit are what we call our monopoly-based revenue sources. And so the classic example there would be a utility. Utilities, you can then charge people for the benefits that they are getting from consuming those utilities. So things like transportation, water services, they tend to be monopoly-based revenue sources, but they also tend to be somewhat amenable with user charges. We have an extensive government involvement in these monopoly-based types of revenue sources because we want to make sure that we can keep costs low, that these things such as utilities and water and these staples of life are not being rationed so that lower income individuals do not have access to them. And by generating revenue from these monopoly-based revenue sources, we tend to generate a large amount of revenue. Now, years ago, when we had truly public utilities, where we had governments that owned and operated their own utilities, some of those governments refer to themselves as being low tax governments. And sometimes they call themselves no tax governments because they were generating so much revenue from the operation of this public utility that they did not have to charge taxes. Now through deregulation, we no longer see that being the case. And so all cities will rely upon taxes to some degree or another, just because you don't have the same adequacy you used to have before deregulation efforts. Another example of monopoly-based revenue source, state-run lotteries. You're probably familiar with state-run lotteries. The vast majority of states either have their own lottery system or they participate in a multi-state lottery system or a combination of the two, like we see here in the state of California. Lotteries have been with us for a very long time. Majority of states do engage in either their own lottery system or in a multi-state lottery system. We're not going to go through all the different types of lotteries, but we do have to recognize that there are some criteria that will have an impact upon just how adequate these types of revenue sources are. I think there's a very interesting table in the Mike Sell book where he looks state by state at state-run lottery systems to look at how much overhead costs they have in comparison to amount of revenue that they are generating. Some state-run lottery systems are very overhead intensive, and they actually generate less revenue than they cost in terms of administrative costs. Here in California, our state-run lottery system tends to be one of the more efficient lottery systems across the country in that we tend to keep administrative costs low and we tend to generate a whole lot of revenue. As you know, these lottery systems were sold to voters in that it will be a source of revenue that can then be used for education. Here in California, we do use lottery funds for education. Here at Cal State Long Beach, I serve on the faculty council, and one of our major jobs in the faculty council is to approve lottery proposals. And so departments will submit their proposals to then get funded through these lottery funds coming straight from the California State Lottery. In order to be able to get a proposal approved for lottery funds, it must be directly related to instruction. It can only be used for instructional related activities. So typically we see departments like a nursing department that has a lot of requirements in terms of hardware that they need to use in their labs and in their clinics directly in the instruction process. So lottery funds do flow into state universities, lottery funds flow into community colleges, and lottery funds also flow into K through 12 local education agencies. They were sold on, we are going to be able to generate all this money for education. However, if you look at K through 12 funding, lottery proceeds make up usually less than 1% of the revenue that goes into local education agencies at the K through 12 level. The problem with these state-run lotteries is obviously they tend to be relatively regressive. They have a lot of externalities, and so they can result in addictions, they can result in higher crime rates, and they can also result in a lot of regressivity in that they tend to influence and impact lower income individuals more than upper income individuals. But it does count as what we consider to be a monopoly-based revenue source. The basic rule of thumb, though, is we have seen in most states, especially here in California, a pronounced shift in terms of revenue generation away from traditional tax-based sources of revenue and a shift more toward non-tax revenue sources such as user charges and user fees. And again, there are a lot of advantages to utilizing user charges and user fees, but there are limitations, and we'll never be able to completely supplant our tax sources with only user fees and user charges. So that's essentially our discussion of taxation. We've gone through the 5 evaluative criteria of taxation. We've gone through our 3 primary tax sources, their advantages and their disadvantages in comparison to those 5 evaluative criteria. And then we've talked about this pronounced shift away from tax-based sources and shift more toward non-tax sources such as user fees, user charges, and to a lesser degree, monopoly-based revenue sources. So this can then provide you with all the information and then some that you need to then respond to scenario number 5 on the final assessment. The last piece of the puzzle, the last component, will be those intergovernmental resources. And as we saw in our chart, the average California city is going to generate around about 9 or 10% of the revenue from federal and state government sources. The problem with intergovernmental revenue is it tends to be much more transient and much more temporary and much more unstable than own source revenue. We don't have time to get into intergovernmental fiscal relations tonight, but what we will do then next week is we'll look at this final piece of the puzzle, intergovernmental fiscal relations. We'll look at grants and we'll look at the fiscal impacts of mandates and talk about what it means for local governments to become reliant upon money flowing in from federal and state governments. And then that will wrap up all the information we typically cover in this class. Again, hopefully give you a little bit of time then in our session next week so we can break early and you can then work on Canvas essay number 5 as well as your final assessment. Any general questions about taxation, this information that we have covered tonight? Okay, I apologize for talking so much, but again, we're squeezing all this information into 6 weeks together, and it is a lot of information. It's very much accelerated, but we want to make sure that you get the same coverage of information that someone who takes this class on campus during a 15-week semester gets, so that you have all the information that will prepare you for completing the budgeting case study once you get to PPA 697. As you work on Canvas essay number 4, and as you work on your post-instructional assignment, feel free to reach out to me. I think it was pretty straightforward in terms of what you're doing on part 1 and part 2 of the post-instructional. I would just say, as you think about the cuts that you are making in your consolidated budget, think about the practicality and how reasonable and realistic those cuts are. So I would say try and spread your cuts out across different categories. Don't focus too much on one category of spending. I've seen in the past people really focus on acquisitions and essentially zero out the acquisitions line item. That's dangerous, because once you get rid of all acquisitions, you have no new material coming into the library. You can't refresh any of your material. So try and spread out your cuts across those different categories. Again, your first thing you're going to want to do is you're going to want to come up with your target figure, which will be adding up all the amount that's being spent in the aggregate budget, reducing that by 3%. That then becomes your target figure. It should be somewhere in the range of about $2.9 million, somewhere around there. I won't give you the exact number, but if you're in the $2.9 million range, then you probably have the right target figure. Then it'll be a matter of then going back and abiding by all of those other parameters, going back and standardizing your salaries to the highest salary currently being paid, eliminating your head librarian positions, just going through all those different requirements that I provided you with. And then hopefully, then you'll then be able to make your cuts and then hopefully get down to your $2.9 million figure, and then provide me your justifications for the cuts that you made. So a pretty straightforward assignment, just to make sure that everyone has the ability to work through a simple assignment and put together a relatively simple line item budget using Excel. If you're not very familiar with Excel, again, I have included in our Canvas site those tutorials that were created by Dr. Moore a couple of years ago. There are a series of, I think, I forget how many, but 6 or 8 videos that will take you step by step through how to use Excel. And so if you're not familiar with Excel, I do recommend that you take a look at those videos, and they are very, very helpful. Okay. It is 8:30, so we actually got done with about 15 minutes to spare tonight. So that's kind of the accomplishment for everything that we have covered. If there are no other questions, then we can call it a night. And again, if you have any issues as you're working on your post-instructional, feel free to reach out. All right. Hope everyone has a great week, and then we'll talk to you one last time next week on Tuesday. Take care, everybody.
Thank you.
Thank you, guys.
Thank you.
Thank you.
Thank you.